If you raise the cost of a UK mortgage by like a single percentage point a decade ago, the London property market would have barely even noticed.
Yeah, it would have been a blip.
Right. But today, that same 1% it's fundamentally rewriting the demographics of the city. So welcome to today's deep dive.
Glad to be here.
We are opening up our notes on the London Property Market Digest today. And look, we're not just going to read you some dry financial report. The mission here is to map out exactly how macroeconomics dictate, who gets to live where.
And the catalyst for this whole rewrite is a pretty major macro shift. Over the last year or so, the market kind of priced in this assumption that inflation was, well, finally tamed.
Which initially pushed mortgage rates down, for a little while.
Exactly. But that optimism is evaporating fast. We're seeing energy prices creeping back up, and that injects this really stubborn inflationary pressure right back into the system.
Oh, wow.
Yeah. So lenders are responding to that long-term risk. They're pulling rates from roughly 4.5% up to 5.5%.
Which, it sounds tiny, right? But instead of looking at the market like a giant seesaw of supply and demand, it's really acting more like a stress test on London's financial fault lines.
That is exactly what it is.
It just instantly exposes who is relying on local debt to survive and who is, floating on global equity. When you apply a 5.5% stress test, you immediately lock out a massive tranche of domestic buyers.
Because the sheer scale of borrowing required in London just completely magnifies that single percentage point. Lenders enforce strict affordability criteria, obviously.
Right.
And at 5.5%, a huge portion of local salaries simply no longer qualify for the required loan quantum. It's a hard mathematical barrier to entry.
Which chokes out transaction volumes. But wait, the math doesn't add up there.
How so?
Well, if everyday buyers are suffocating under those strict affordability tests and getting completely locked out, transaction volume should be dead and prices should be an absolute freefall.
You would think so, yeah.
Right, why aren't we seeing a massive crash?
Well, it's because you're looking at London as a single unified market, when in reality, it operates as two parallel dimensions.
Parallel dimensions. Okay, unpack that.
So you have that highly vulnerable domestic buyer, right?
Yeah.
The one relying on traditional retail financing. But sharing the exact same postcodes is this massive contingent of cash buyers and international investors.
Oh, meaning they don't even blink at a UK mortgage rate hike.
Exactly, because they aren't borrowing from UK retail banks. They are completely insulated from domestic monetary policy.
That makes so much sense.
Right. If you're parking overseas capital in London brick and mortar, the Bank of England's base rate is, it's completely irrelevant to your purchasing power.
Wow.
That insulated segment essentially acts as a concrete floor under London property values. It prevents the crash you'd mathematically expect from just the domestic squeeze alone.
So domestic sellers are basically trapped in this weird middle ground.
Yeah, pretty much.
They have to wait longer to find a buyer and maybe negotiate a bit more. But they don't have to drop their prices into the basement because they know that concrete floor of international wealth is holding things up.
That, and they also know there's virtually zero new inventory coming online to compete with them.
Which brings up the supply issue.
Exactly. That structural housing shortage is the other major force counteracting those high borrowing costs. Decades of constrained building, really tight planning permissions. It means supply is chronically choked.
So even when debt is incredibly expensive for the average person, the absolute physical scarcity of homes just creates this baseline of demand.
The demand that absolutely refuses to dissipate, yeah.
So if you're a regular buyer trying to navigate this, it sounds like trying to perfectly time the interest rate cycle is basically like trying to catch a falling knife.
Oh, absolutely.
Yeah.
The consensus in all our sources strongly advises against trying to time the rate cycle perfectly.
It's just too risky. You'd be betting against global inflation trends and a chronic local supply shortage all at the exact same time.
Right. The strategic move is prioritizing long-term stability. Securing a rate that guarantees a manageable monthly payment protects you against sudden inflationary spikes.
Rather than gambling your whole housing situation on a macroeconomic pivot that might, take years to actually materialize.
Exactly.
So we end up with this intense slow-motion collision. You've got expensive local mortgages severely restricting everyday access, while absolute physical scarcity and immune international wealth keep prices historically inflated.
It forces us to look at real estate not just as housing, but as a global reserve currency that just happens to have a front door.
That is a wild way to think about it. Which leaves a final massive question for you to consider as we wrap up. If international investors and cash buyers remain completely insulated from these rising domestic rates, while the everyday professional is permanently squeezed out,
Yeah.
how does that fundamentally change the cultural and demographic character of a global city like London over the next decade? When the people who physically run a city can no longer afford to live in it, what does that city actually become?